We borrowed some money a while back, $2,000 worth, and we're going to start paying it off. We'll make the first monthly payment of $178. Some of that is going towards paying the loan itself to get the loan balance down, and some of it's going to be to pay interest at this high 12% annual interest rate. Oh, what do we got going on here? Well, since we're going to pay, we got cash, but what else is going on here? We got cash involved. The liability is going to go down. I'm getting ahead of myself here, but the liability is involved, but we also, hey, we use this money. Interest expense is the cost of using money. We use this money for a month. That's part of cost of doing business. That's an expense. Interest expense is just like any other expense. So we got three things. We got cash, notes payable, and interest expense. And let's figure out what went up and what went down, what happened here. Well, first of all, let's calculate the interest. It's a $2,000 loan, 12% interest, but it's only been 1 month. So the interest rate, as it says here, is an annual amount. Well, we've only had 1 month, 1/12 of a year. So if you do that, you can check my arithmetic, but I'm pretty sure this is right. 2,000 times 12%, that's $240 a year. But we've only had 1 month go by, so we divide it by 12. It's $20 interest. In other words, for renting this money for 1 month, for using this $2,000 for 1 month, we got to pay 20 bucks. That's part of the cost of doing business. Okay. So cash just went down by 178. We made a payment of 178 here. There it is, 178. But guess what? Part of that goes towards paying interest. We've got more interest expense. We just computed that. It's $20. But why, if our interest is only $20, why did we send in $178? Are we just a charitable group? We just want to give people money away? No, we're going to say, okay, our note payable's got to go down by the difference, 158. Sometimes the phrases are used: interest, $20, and principal. The loan itself just went down by $158. Okay, let's just hang on. We're all right. Let's see if we can convert this into debit and credit language. Cash goes down, so that's a credit to show that that asset goes down. We paid $158 to reduce the loan, so that's a debit to show that notes payable goes down. And the interest expense, we got more interest expense, but that means that equity goes down. More expense means less equity, so we're going to debit expense. And now let's stop. Do we usually debit expenses? Let me think. Oh, wait. We always debit expenses because they represent decreases in equity. We always debit expenses. So here's what happened. Let's look at the journal entry and let's make sure we understand everything that's there. We sent in a check for cash, 178. So that asset, cash, went down. We show that with a credit. We said to them, hey, $20 of this is interest. Or we didn't need to say it to them because they can compute this $20 just the same as we can. That's part of the cost of doing business. That's my expense. EQ stands for equity. My equity just went down. More expenses mean less equity. But since I sent them $178 and only $20 was for interest, the remainder, the $158, must have reduced my liability. I now owe less. In fact, we could figure it out. Let me try to do it in my head here. We owe $2,000. We just sent in $178. They skimmed $20 off the top, meaning $158 was left to repay the loan. So now I don't owe $2,000 anymore. I owe, let's see, $1,842. Check me with your calculator. Hey, let's declare and pay a dividend, $50. Cash dividend. All right, cash is involved, dividends are involved. Good, fine. So far, so good. Dividends, by the way, are not an expense. There's no such thing as dividend expense. If you say the words dividend and expense right together, you're going to get yourself in trouble. Federal authorities will be involved. So don't do that. Dividends are not an expense. Dividends are not a cost of doing business. Dividends are just owners taking some of the profits of their business out. Dividends are not an expense. Guess what? Dividends are not an expense. So we got cash involved here and dividends, which are not an expense, also involved. How about the cash? It went down. From the standpoint of the business, and again, we're accounting for the business here, cash just went down. Our dividends went up. We've just now paid out more dividends. So dividends went up. Okay, we haven't done this before. How's this going to work debit and credit-wise? Well, the cash part's easy. Asset cash went down. Dividends, we got more dividends, but since dividends are an equity account, they're subcategories of retained earnings, just like revenues and expenses. More dividends means less equity. More dividends means less equity. That's why we got the debit here. And if we convert that into a journal entry, we see the asset cash with a credit here, representing a decrease in cash. And dividends, since it's a debit, it's showing that our equity just went down. The equity of my business just went down. The business equity just went down because we took assets out of the business and gave it out to the owners for their personal use. Equity of the business went down. The owners have got the money now, but we're not doing the journal entries for the owners' personal lives. We're doing it for the business. And from the standpoint of the business, equity just went down. Cash went out the door.